Hi guys, welcome to our channel. I'm Urvashi.
I'm Vikrant, and this video is about the differences between direct and regular mutual funds.
And we are also going to see why direct mutual funds are the better option.
So keep watching.
In most of the cases, if you buy your mutual funds from your investment advisor or your customer relationship manager at your bank, then there is a high probability that they are selling you regular mutual funds. Whereas if you buy from Zerodha or MyCamps or Bank Bazaar or from the website of the fund house, then those are direct mutual funds.
So friends, let us first understand that how mutual fund houses make money. It is obviously not a charity. They have to earn something, right? And they have their own expenses, they have their employees, operating costs. So for these purposes, mutual fund houses charge you an expense ratio. So guys, expense ratio is nothing but an annual fee which the mutual fund house charges their customers to maintain their funds and give them profits basically over the period of years. So let us understand in more detail how this is done. So friends, expense ratio is given out by mutual fund houses on a yearly basis. They generally declare the expense ratios to be in percentages. So they can be 2%, 1.5% and so on and so forth for different types of mutual funds. But how is this expense ratio applied? So for that we need to understand the asset under management. So what is AUM? AUM is nothing but the total assets which the mutual fund houses manage. For example, you invest 10,000 rupees in that mutual fund. Similarly, many people from around the world will invest some amount of money in that mutual fund. So the total amount of money that the mutual fund is handling and their current value is nothing but the asset under management. So how is the expense ratio applied to the assets under management? So for example, if we have a mutual fund whose total assets under management are 1 crore and the expense ratio is 2%, then we calculate the daily expenses of that mutual fund using the given formula, which is nothing but the expense ratio multiplied by the assets divided by 365, which gets us to around rupees 545 per day. Similarly, if another mutual fund whose expense ratio is 1.5% will have an expense of around 410 per day. So how does this impact you? What happens is, supposedly the value of the assets of a mutual fund is 1 crore, daily 500 rupees or 545 to be precise will be subtracted from its value, and the remaining value will be the value of the mutual fund units you hold. From this we can conclude that the lower the expense ratio, the higher are the returns of a particular mutual fund. Friends, please also note that in the case a mutual fund is performing negatively, the expense ratio is still charged. So expense ratio is not dependent on the profit of a mutual fund. It is a constant amount which is going to be subtracted from the value of the mutual fund. Now let us take an example. Here I am considering HDFC Tax Saver Fund, the growth option. As you can see on the screen, this is a regular plan with an expense ratio of 1.83%. Similarly, the direct plan for the same fund with the same growth option has an expense ratio of 1.28%. So in this example, the assets under management is nothing but the fund size, which is 6,748 crores. Now as you can imagine, the smallest proportion of this figure will get us to the daily expenses of 33.8 lakh for this fund in the regular variant, whereas in the direct variant, the daily expenses come to 23.66 lakhs. Now the difference here is about 10 lakh rupees per day. Where does this money go? This money is paid out to brokers, middlemen, and to your investment advisors or your relationship managers who are working in the banks for selling this mutual fund. So if you want to save this money, you have to invest in a direct plan.
So you guys must be wondering how this affects you as an investor. Now let us see an example. Say if you are investing 10,000 per month in a mutual fund for a period of 25 years, and for the sake of calculation, let us consider the rate of returns as 12% per annum. Now if you invest this amount in the regular variant of a mutual fund, the corpus that will be generated after a period of 25 years will be 1 crore 70 lakhs. Whereas if you invest this amount in the direct variant of the same mutual fund, the corpus that will be generated is 1 crore 89 lakhs. So the difference here is of 19 lakhs. This difference is because the expense ratio in a direct mutual fund is much lesser than the expense ratio in a regular mutual fund. In this example, we considered the rate of return as 12%, which is a very modest rate, but this difference will grow even more if the rate of returns is higher due to the effect of compounding. So guys, if you find this video useful, please like and subscribe to our channel.
Thank you.
Bye.
Bye-bye.